Good afternoon. Welcome to the TheoTRADE afternoon video. I'm Blake Young. Today is March 7th, 2024, and today I found the market's next big catalyst. Now, before we get into what that big catalyst is, I want to have you look at the big picture. This is going back the last decade, 10 years on the weekly charts on the S&P 500. And one of the things that we can note is that we have rallied all the way from these lows back in around 1800 up to 5,165. This massive move, as we're looking at this, is highly correlated to consumers. Now, this is a big argument that I always have, that we talk about tech, we talk about the idea of seeing the equity market go higher and being driven by tech, but reality is the underlying drivers of any economy is the consumer. So you'll notice that I have this tied in down at the lows, tied into the consumer discretionary ETF XLY. Now, if we're looking at this and saying XLY is that main component of the broad economy and the S&P 500 is the main broad index for the economy, ignoring tech alone, there's a very high correlation, 89-90% correlation as of today, looking at week to week, and you can see almost the entire time for the last decade we've been above zero. We had maybe 1 week that we did not have it stay above zero positive correlation, and the bulk of the time we're in the 80s and 90s as far as correlation between the S&P and consumer discretionary. So consumer discretionary spending, and really consumer spending in general, accounts for 65% of GDP. It can be a great representation of what we can expect going forward in the economy. Now, the question is, we're seeing signs about a slowdown in the economy. In fact, the European Central Bank said that they have downgraded and lowered projected expectations of GDP. They're pushing these down into the low twos and the high single digits as far as percentage growth year over year, and they left rates high. So here we are leaving rates high to keep fighting inflation, and yet we're seeing growth subside in the Eurozone into roughly about 2% annualized projected forward-looking returns. Now, that's still going to be driven by consumers. The question is, what is a better representation for consumers if we're looking at XLY? As XLY is a representation of consumer discretionary spending, not just consumer staple spending, are we maybe considering the wrong companies as a better substitute for consumer discretion? Are we going to see a catalyst that could be an indicator of what we are seeing in the economy and some individual stocks? Well, the short answer to that is yes. If we look at XLY's top holdings, Amazon is 26% of the weight of consumer discretionary. 26%. You would think that in and of itself should be enough. Then Tesla, 12%. Well, we're not really spending 12% of our discretionary income as consumers on Tesla. I don't think that's a very good representation. We might be spending 26% of our discretionary income on Amazon. But are we spending 5% at Home Depot? I certainly hope not, that we're not spending 5% of all of our discretionary income at McDonald's. So as we look at these holdings, are these really the proper information to be weighing consumer discretionary spending? Are homes, D.R. Horton, are homes really an indication of how we spend our discretionary income? Are we spending 1.5% of our total discretionary income on Lululemon yoga pants? Or Airbnbs, for crying out loud? Maybe Starbucks. We might be spending 3% of our discretionary income on Starbucks, but I don't think this is a very good representation of the economy and consumer spending. And yet, when I look at some individual stocks and the consumer discretionary spending, they seem to mirror the XLY better than Amazon. Let's first take a look at Amazon. Now, we won't get into the granular components of this, but I want you to look at XLY compared to Amazon here. And we don't even have the same correlation from Amazon, which makes up 26% of XLY, that we do with the S&P 500 versus the XLY. XLY is more correlated to a broad 500 stocks than it is to the largest single component of XLY. Now, that's some weird math. That tells me that Amazon really isn't representing what consumers are doing, and when 25% of it can't outweigh the other 75%, that's when you see these massive decoupling, where we have week over week where we shoot well below the 0% level. That's when you can have this correction from 188 all the way down to 80 or 70 and see nearly a 50% correction in 21 to 23, without it really messing with consumer discretionary spending. So I just don't see Amazon as a really good representation of consumer spending, or XLY as far as discretionary income. But if we take a look at Costco, Costco is a different beast. As you look at Costco, we stay above the 0% line. We stay up here for longer time periods. In 2001, 2002, 2003, we climb just like U.S. equities did and just like consumer discretionary did. So XLY actually holds up closer to a correlation, and I have to change this zoom function to 1 and -1 so you can see what it really is supposed to look like. And this is the correlation between Costco and consumer discretionary. Now Costco has had a great run this year and has climbed just in the last year from the last major earnings in spring of last year, has almost increased by double. Amazing run, lots of bullishness, pushing up to these highs today at 786. They have earnings tomorrow. The question is, with earnings tomorrow, are we going to see the support, the backing to see Costco continue to move higher? Are we going to see Costco move its expected move going into tomorrow's move? And that's pricing in about a $43 move in Costco. $43 tomorrow, 51, 54, 56. So we're looking for another $50 move up potentially in Costco if they outperform. Let's go to the Analyze tab and focus on the fundamentals. From the Analyze tab and the fundamentals, you can see their earnings per share. Costco just doesn't lose. The 5-year trend is up, 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 up. Every year for the last 5 years, they've had higher and higher and higher earnings. They've increased their year-over-year earnings per share by 7%. You can see in 2019, it went from about 8 to 9 to 11 to 13 to 14. So it seems to be slowing down a little bit here, but are we going to see this continue to climb? And analysts' projections and how Costco performed with those projections have been a pretty strong indicator as to what the market is going to do next. They haven't missed for a while. They've actually outperformed. So if we go back into that chart and look at the outperformance versus misses, and we look into this last couple of years, what you'll see is when they beat expectations, they keep climbing. When they beat expectations, and it just has to be a penny, 2 pennies. This was 16. They paused and then kept on climbing. This one, they kept on climbing. This one over here, they kept on climbing. They beat it by 10 cents. Over here, they missed. And what did we do? We dropped. So missing analysts' expectations, Costco fell from $5.30 down to $4.30. $100, almost 20%. Off of a miss of expectations. So they don't miss very often, but when they do, they slide. When they miss, they slide. And so this one they beat by a penny, and even this one they paused and went higher. Now I know we're not lining it up perfectly because I'm looking at a weekly chart rather than the daily chart, but I wanted you to see back here in 2021, 2022 that when we had a miss, we were selling off 5-10%. So the market really prices in what they think is going to happen with Costco. When they beat, they either trade sideways because they beat expectations, met the market's expectations, they hold or move higher. When they miss, they fall 5%, 10%, 20%. And so as we're watching going into this earnings and the expectation, Costco is a very strong representation of how analysts are seeing the economy. Analysts are seeing the markets. And this is another reason why I believe this is the case, is because Costco's revenues are about half based off of the membership. That membership is what people give up if they're looking at saving money. So if we see Costco see less signups, less renewals, less memberships, and we see that pull back, that's an indication of 2 reasons why consumers are spending less. One is they're spending less at Costco in general, but they're letting memberships lapse or not paying for renewals. We have a new CEO, a new CFO at Costco, so these first quarters are going to be very interesting to see, but the market is absolutely pricing in growth in Costco. Going back to the Analyze tab, there's very few companies that I've seen that have this consistent of price to earnings ratios, price to cash flow, price to book, dividend yields, and you can see consistently 5-year average, 5-year average, 5-year average down here are basically the current valuations. So Costco is a rock. It's steady as far as that goes. Now, even though this shows that it's sliding, we're just seeing a little bit of slide from the 5-year to the 3 years as far as total revenues, but we also know their earnings per share have gone up. So their net revenues and their total revenues maybe have slipped a little bit, but we're comparing the current versus the 3-year and 5-year average over here. But consistently, we're roughly at the same cash price to cash flow, price to book, price to earnings ratios, market capitalization, and dividend yield as we've been at the 5 years. So they've been a very, very steady, consistent indicator of, one, a company that you can trust, but also something that represents the entire economy. As we look up here again, we just had an increase from 2023 to 2022 to 2023. And if we see this quarter outperform analyst expectations, we have more upside to go. Like we said, probably $50 over the next month. So Costco could be reaching up and reaching new heights and representing a consistently stable economy. But if they miss, if we see that the fact that they have exposure in Europe, that they have exposure in China, that they have exposure in Korea and Taiwan. So Asia is slowing down and gone negative. Europe is slowing down and reducing their projections going forward. These all could be indications that we're going to see slowdowns in the overall company, which will feed into the United States, which makes up the bulk of all the warehouses. Now, there are a couple other things we want to look at in conjunction with everything that's going on. Number one is looking a little closer. We have expectations right here on earnings that are reporting tonight of 362. So we're expected to beat last quarter and be above $3.62 a share. So watch for that number, number one. Number two, I'm comparing Costco to inflation. Now, this DBC versus bond prices is a representation of a risk-free premium versus Deutsche Bank's commodity fund for general commodities. And when this is rising, that means inflation is going higher, and we'd expect Costco to struggle to make money because people will have less money to spend. When inflation is consolidating, disinflation is occurring, we really expect an acceleration because costs are going down and consumers are going to have more money to spend. And you'll see when this is falling, this is taking off. Pay attention to the average yellow line. Right now, it's staying flat, but flat near annual lows. And I think that's part of the reason why we're still seeing it climb. If this turns back up, if inflation turns back up, and if we see consumers miss on their earnings and consumers slowing their spending, even with inflation down, that would be a significant pullback in Costco. Again, $50 probably by the end of next week. Possibly $100, we could go from $785 down to $700, even $685 back here. But if they beat earnings expectations and inflation stays low, then we should expect it to continue to move. And we're talking about this channel width, which is about 40. But I would say $50 by next week and possibly $100 over the next 2 weeks, which could be all the way up to $885, pushing to new record highs and pushing Costco closer and closer to the $1,000 club. In addition to beating earnings and getting future guidance, we want to pay attention to their guidance, as that can be representative of the overall consumer and their spending habits looking forward. They're paying very close attention to how consumers are spending and how they're adjusting their spending. Even if they beat earnings expectation, if they warn about lower quarters next quarter, and we see non-farm payroll miss its expectations, that would be also the major warning for us as we go forward into the next quarter for the U.S. economy as well as just Costco. Expectations currently are that we are going to add 200,000 jobs, but 200,000 jobs is significantly lower than what we reported last month. So we are seeing slowdowns in hiring. We're seeing more increases in layoffs and new unemployment filings. And again, the question is that going to have already played into Costco spending? Or is Costco's guidance going to be following non-farm payrolls data tomorrow? That's going to do it for me. Watch for the earnings to come out in a very short period of time, here in about an hour. And we will see where things are going and maybe what we're looking at for the entire next quarter for the U.S. economy and the U.S. stock market.